Welcome, everyone, to the fifth session on day one of the Modern Investor Summit. I'm Max Rothery, VP of Community here at Finimize, and I'm joined today by a special guest, Lane Clark, co-founder of TPP. Now, Lane spent the last 20 years as a broker, trader, and hedge fund consultant. After trading billions across equities, derivatives, commodities, he founded TPP, a business there to empower investors globally and assist them in outperforming the benchmark. How are you doing today, Lane?
I'm very, very well, Max. Thank you very much for having me on the show today.
So I just want to say a huge thank you to TPP up front. As a session partner of the summit, TPP showcases experienced traders, their trading strategies, and these trading strategies have managed to outperform their market benchmarks by a minimum of 1.5 times over the last 5 years. There's no management fee involved. There's no performance fee involved. It's a very simple subscription model. It's great to see platforms like this come and help us democratize the world of investing. If you haven't already, guys, please introduce yourself in the chat box with your name and where you're tuning in from. As always, we'll follow the Finimize format. There's a 15-minute chat between me and Lane, followed by 15 minutes of Q&A with you guys. Throughout the Q&A, we'll make sure that the best questions get asked at the end. And that's it. We'll might as well start diving in right from the top. Lane, we're here today to talk about DIY investors. And the hallmark of the modern investor is this DIY movement. It's their self-regulate with our global community, and 73% of them said they would rather self-manage their funds than work with a fully delegated financial advisor. What's driving that?
Fantastic starting point, Max. I would say the main reason, and it's a hard-hitting statement, there's a lack of faith in the establishment. Investors are frustrated, and what the result is, they're educating themselves. So, platforms like Finimize, obviously a great medium to do that. And I think the summary they're coming to when they do educate themselves is performance just isn't good enough. And ultimately, fees are excessive. And therefore, these investors, who most of them are intelligent, successful, they want to self-navigate their portfolios. And it makes sense because ultimately, yes, that's a bold statement for me to start this chat with, but the stats back it up. If you have a look at the UK, for instance, off the top of my head, I think it's 80% of active fund managers underperform their market benchmark over the last 10 years. And then to compound that, if you look at the fees, investors in the UK alone are paying £150 million a year in fees for that underperformance. So, you tell me, Max, can you see the reasons why investors are looking to obviously take more control of their portfolios?
Yeah, totally. And, we've got better access through tools, better access to information. The regulations are putting more pressure on us, especially in the UK. What are the risks of doing that yourself?
Yeah, from a risk perspective, I guess an investor, I find they lose too often and too much trying to take on too much risk. Now, reality is most of these people who trade themselves, like I said, they're intelligent, they're successful in their own domain, and they understand the markets. What they don't understand, in my very humble opinion, is how to position size. So if you have a look at some of these retail brokers that offer kind of, the excessive leverage, 100 times leverage, 500 times leverage, and investors attempt to take advantage of this, this is where it often goes wrong. And you only need to read the stats on the bottom of all of these broker platforms where it's clearly stated, 70, 80, 85, 90% of people who are investing themselves lose. So though it's a great idea, taking that control, ultimately, it isn't working for all. And I think the main reason is people are chasing that holy grail. They take on too much risk. And when you chase performance and take on too much risk, at some stage, something will go wrong, Max. Does that make sense?
Makes a lot of sense. Could you give us a bit more clarity on this, how to position size? Like, what do you mean by that?
Well, if you look at the retail brokers like we discussed there, in my eyes, no investor should be using 100 times leverage, 50 times leverage, 500 times leverage. Something at some stage will categorically go wrong. We'll talk about our platform slightly later in this conversation, Max. But to give you an idea, professional traders, our traders are using about 2.2 times leverage on average. So professional traders use that as a invaluable investment tool. Why should retail investors use 50 times leverage, 100 times leverage, 500 times leverage? The key for me, if you're an investor, is find a methodology that consistently works. So whether that's fundamental investing, whether that's technical investing, once you find a methodology that works, manage your risk effectively, position size effectively, and over the longer term, you'll reap the rewards.
Yeah, I love that idea. We've now sort of dived in a little bit to your point around positioning size. Let's talk about leverage. Where do your professionals use leverage? Like, where is leverage a good thing to use in your investing strategy?
At the right times. No, that's a simple answer there. So if you have a look at over this year, trading year, for instance, if you look at the FTSE, it's obviously done very little. It's negative, and most of our strategies are substantially up. They had a poor November, but over the year they're substantially up. And if we look at that FTSE, it's traded within quite a tight range, and it's moved up and it's moved down. So where a professional might use leverage, if they're trading the FTSE within that range, it doesn't have to consistently go up. They can wait for a market dip and add a slightly larger position. Keep ammunition on the side, add a position when the markets retrace. When the markets come back up, scale that position off. So you've still got that long position in the markets waiting for that longer term growth, but at the right times, employ a slight bit of leverage, a slight increase in position size, and reap the rewards. So yeah, from our kind of particular scenario, using the FTSE as an example, I've probably noticed on maybe 4 occasions this year where markets have came down, extra position size has been added, markets have came back up. Now, as a traditional wealth manager, you're sitting there at that stage just hoping the markets continue to go up. Reality is markets don't operate like that. They go up, they go down, and that's what a good trader would do. Not a day trader. In my whole career, I've never met a successful day trader, but somebody who knows how to tweak and modify portfolios here and there, can take a portfolio that tracks the market to one that beats it consistently. Does that make sense, Max?
Yeah. So we'll talk about the dangers of doing it completely yourself, and we'll come on to a bit of sort of augmenting that with some professional help. But we had Ray Dalio on today, and his key message was diversification, keep it simple. Wouldn't we just be better as retail investors just chucking it in a pre-made fund or a S&P 500? What's your view there?
Yeah, in simple terms, I would say that. So if you look at the typical fund manager who's underperforming, obviously their market benchmark, who's charging too much, in my opinion, and again, it's a bold opinion, the model is stale and outdated. And just look at it like this. If you're a fund and you've got 150 billion under management and you're charging 1% per year to outperform, where is the incentive there to consistently go and beat your market benchmark? There isn't one. And if you take on too much risk, like we said earlier, you chase performance, take on too much risk, at some stage, something somewhere will go wrong. And the results reflect this. So going back to your question, Max, as an investor, wouldn't it make sense just going into an S&P 500 tracker or a similar type tracker? Definitely. In my mind, and again, only one man's opinion, an investor would be much better educating themselves and building a diversified global stock market portfolio, and they would consistently beat most, not all, there's been some great people on here today, most fund managers. If you waited for a market retracement and bought, as you said earlier, Max, S&P 500, FTSE, NASDAQ, Dow, DAX, Nikkei, bought them at the right time, buy and hold, you would categorically outperform most fund managers. And that's what I believe most UK investors should approach the markets, how I believe they should approach the markets.
I guess the key to wealth management is in the name wealth, right? Like, because there's a lot of benefits to having a wealth manager, security, confidence, the fact that you don't have to worry about your investments. So in your opinion, is there a sweet spot into how much wealth you're accumulating where you say, you know what, I'm not going to do this myself anymore. I'm going to just hand this over to someone else?
Yeah, no, it's a great point. And I do think as investors in general, particularly in the UK, that they know nothing better than earning money, doing very well in the career, and handing it over to their IFA or the wealth manager. And reality is, most of the time, it doesn't pay off for them. So I think at a certain stage, and whether you've got a 20,000 portfolio or a 20 million pound portfolio, you should take more responsibility. Now, we talk to investors globally, and it's weird speaking to different people in different countries in regards to their knowledge on the market and how they'd approach it. Classic example, US. To me, the investors seem far more sophisticated. They know where to invest. They know how to access low-cost trackers. I was speaking to somebody in the UK recently. I won't name him in case he's watching it, but incredibly successful individual, CEO of a large FTSE 100 company, working with a company who charge large fees, large exit fees. And I said to him, I said, look, what made you go there? I just can't get my head around it. And he said, as an investor, we don't know much more. He said, so we go to these companies because they have a satellite office when they drop the kids off at school outside the gates. Your money feels safe. But reality is, investors have to educate themselves more. And if they did that, they'd have a far better portfolio. And I would say, Max, that is whether you've got £20,000, 2 million or 20 million. It would make sense to do that, educate yourself more, learn more about the markets, and start putting your methodology to test.
Well, that's certainly a philosophy that we'd agree with at Finimize. Now, one of the reasons that, so my background was in wealth management previously. One of the reasons we always used to, one of the mantras we would talk about is how clients would come for performance but leave for service. But actually, clients also leave for performance, right? So the thing that drives decisions is performance. Your platform is all about delivering that performance element of wealth management rather than, looking at the security and comfort and lunches and dinners that you get treated to up in the West End. Can you talk us through some of those market beating strategies? And can we do this through a lens of, I'm a retail investor, I'm a Finimize community member, and I want to do this myself?
Yeah. So I think in the markets, nothing beats performance. The numbers don't lie. So what we did, and there are other solutions out there as well, we've tried to build a model, just like Finimize, where we're empowering investors, assisting investors. So we've built a platform that showcases market-beating traders and their trading strategies. Now, the strategies showcased on there, they're wide and varied. There's a multitude of different strategies, different techniques, but they all share one key thing in common. And that's all of these strategies have track records of at least 5 years of consistently beating their market benchmark before we consider showcasing them. And so what we've tried to do is bring market beating investing, but to the everyday marketplace. And as well as that, we look at it. And the reason, Max, we've been able to do that, if you look at Ed and I and our backgrounds, like we said earlier, we've worked in and around the asset management space for 22, 23 years each. So the world of wealth management is obviously an incredibly large one. The world of traders is far, far smaller. Successful market beating traders, far smaller again. And when Ed and I joined forces, we said, look, let's build a vehicle that can almost provide a solution to what we believe is a problem in the market. And at first, it was for friends and family. And that's what we've done. We've brought the market beating vehicle, but at the same time, we've stripped out what we believe creates complacency in the wealth management model. There are no management fees, like we touched on earlier. There are no performance fees, so nobody's taking on excessive risk. What there are is market-beating strategies with a minimum of 5-year track record before they're showcased. And then from being showcased, the data's live and every trade is logged in real time. So that's what we're trying to do, Max. And I'm sure, like I said, there are other solutions out there, but that's our kind of contribution to changing and disrupting what we believe is a stale and outdated wealth management model.
So what's an example? Say I put money in TPP and I chose one of the strategies. What's the strategy that you could talk us through?
Okay, yeah, no, great question. So we have 3 different types of strategies on our platform. So there are 25 different strategies, but they fall into 3 distinct categories. So the most vanilla type of strategy on TPP is what we would term a leverage tracker. So if people are used to dealing with that kind of wealth management type structure, it's very similar but on a multiple. So if Max believes the FTSE will go up 6 or 7% on a per annum basis, well, we can offer that with 2 times leverage. So over the longer term, rather make 6 or 7%, you may be making 12 or 14%. That's the most vanilla strategy showcased on TPP. The second type of strategy is what we would term a long or flat, or a buy and flat. And to explain that, if we're looking at, let's say, the FTSE 100 and it's trading at 7200, hypothetically, and we're on the buy side and we buy the FTSE at 7200 and it moves to 7600. Now, if you're a wealth manager, you probably give yourself a pat on the back and say it's been a great year and you're hoping that the markets go slightly higher. Reality, like we said earlier, markets don't go up in a straight line, they gyrate. So what our kind of long or flat or buy and flat structures will do, they'll look to go flat maybe at 7.6, and they won't time every trade, but the theory behind it, they'll go market neutral at 7.6, wait for the market to retrace and buy back in at 7.4, wait for the market to move back up, market neutral once again. So that's the second type of strategy on TPP, and I would say it's a very popular one, and one that manages the volatility very effectively. And then the third type, Max, is slightly what you would consider more of a trading type strategy. Again, no day trading, no high frequency trading, but it's what we would term an active equity long short. So it will take advantage of any opportunity in the marketplace. So it might buy the FTSE and sell US tech, which lots of them have started to do now, kind of, almost what we would term a value spread. It might buy the FTSE while selling the DAX. And that's what we would term as an active equity long short. And in November, Max, full, transparency here, we had a rare poor month. And the reason being, we've started, or many of the active strategies have started to short sell the marketplace. They're looking at US tech, DAX in Germany, and they believe obviously it's overvalued and they're looking for a market retracement. Now, shorting it is one of 3 techniques we use to beat the market, but it's probably the hardest one to time. You're swimming against the tide, markets, go up typically, but ultimately, if you can get it right, wealth managers everywhere, or most wealth managers will lose. And at the same time, you'd be making money as markets fall and looking to obviously buy back in. So that kind of gives you the composition of what the strategies look like, Max, how it would work for a client, kind of the second part of your question there. They would obviously come on, that we're not the custodian, we don't hold client capital. They would open a broker. We typically work with institutional brokers like an Interactive Brokers, and they will link our platform and our strategies to their brokerage account. So reality is we're facilitated this to empower the masses, but ultimately it really starts at about 15, 20,000 pounds and goes northward. So the average account size of us right now is about 125K. We have some guys obviously in multiple millions, but I hope that answers how it looks in regards to strategies and for a client.
Yeah, of course. So, especially what we're seeing with our community is, this acceleration of sophistication when it comes to their investing. And a lot of us understand diversification, understand buying individual stocks, understand investing into active and passive ETFs. But what you're talking about is sort of these trading strategies. For those of us who are looking to embark a little bit on that journey and dip our toe in the water there, what advice do you have for someone who just wants to start using some of these strategies? Where do they begin? Where can they go to for resources? And how do you recommend that they get their feet wet safely?
So general advice in regards to an investor almost goes back to how we started there. Take it easy, test your methodology, take a low risk and put that methodology, to work and stick with it. Often I see successful traders go wrong because they start tweaking and changing what's always worked for them. Ultimately, that's kind of that initial advice. Take it easy, build a diversified global portfolio to start getting your feet wet and get yourself into the market. Stay away from brokers offering 100 times leverage, 500 times leverage. There's only one winner there. You might as well go to a casino in Vegas. So that would be my first bit of advice for kind of that general investor. If you were talking, Max, specifically in regards to TPP, well, how it tends to work is when people come in at those kind of starter levels, the 15, 20, 25K, we would guide them in regards to strategy, stay away from the more speculative strategies and look more towards the leverage trackers, or right now markets are quite high, maybe the buy or flat type strategies. And then, once the feet, to use your phrase there, Max, once the feet are wet, maybe build out that diversification slightly more, build your TPP foundations consisting of leverage trackers and bio flats. And then when the accounts get slightly larger, that's when to add the speculative edge on. Don't come in, even as an experienced investor, to TPP and start picking our most speculative strategies because it might be slightly too volatile, but use it as a speculative edge to build an overall portfolio that's diversified, robust, all weather, and aims to perform regardless of the market climate.
Love it. So just to recap, guys, look out for leverage. It's not your friend. Take it easy, test and learn, and try and stay away from speculation. I've just got one more question. It's a quick one, and then we're going to jump into the questions. So any of you community members that are tuned in right now, get your questions in, and we'll tackle those in the last 10, 15 minutes. So Lane, the question I've got is, as a retail investor, what should I be looking out for next year?
Oh, put me on the spot. Big question, Max. As we sit here right now, I am definitely of the same opinion as our traders and our strategies on our platform. I believe markets are overvalued right now. So I love US tech. I love the AI boom, but sometimes, particularly in the US, momentum and people get carried away. It's almost like a FOMO rally. And the charts that I look at right now, I believe the Nasdaq's due a retracement. I believe the Dow's due a retracement, the S&P and the DAX. They're the big markets for me that if you're saying what should investors look out for, be careful of a market retracement. Now, if we're looking at what's value out there, we'll look at the moment, government bonds, obviously a great kind of portion of one's portfolio, the yields that they're offering. And if we're looking again at global equities, but not on the short side, for us, FTSE 100 remains an undervalued asset class. And again, if you're looking at that midterm, if you can get into FTSE on a pullback around 7.2, 7.3 as a midterm play, it's brilliant. So shorter midterm, Max, sitting here right now, whether it happens before the end of this year or in Q1, Q2 next year, expect a market retracement. And it could be short, sharp, harsh. As an investor, be very careful for this. Invest into the markets with caution. Don't get carried away with the FOMO rally and go gung-ho, thinking that tech stocks will go to the moon. We've been there, we've seen that, we've done that, and lots of us have been burnt on the back of that. So yeah, I believe that lots of global markets will sell off. There are a lot of uncertainties out there at the moment. Inflation is still high, it's coming down. Interest rates still incredibly high. Economic growth doesn't look particularly good. I think there'll be a raft of redundancies next year globally. I think there are headwinds coming our way, and there will be retracements on the back of an overvalued market. But if I could do a spread, I'd be buy the FTSE and sell most of the global equities, and I would have some government bonds in there as well. How's that, Max?
Yeah, I mean, you started off by saying you were making some bold claims. Perhaps your boldest is to come to a retail investor event and denounce tech stocks and try and get them excited about bonds and the FTSE 100. No, look, I really appreciate it, Lane. It's often people will shy away from giving direct answers, but I very much appreciate it.
Max, just to interject, I would caveat that with I'm a massive fan of US tech, AI, and over the longer term, it's a fantastic investment. But we look at things in a slightly shorter term time horizon. And as I look at equities right now, the same as many of our strategies, to me, they look overvalued. And that's all I would say as an investor. Be very careful. Our professional traders right now are on the short side. They may get this right. They may get this wrong. Stats say we get 70 to 80% of every single trade that we do, regardless of climate, correct. And I think with the markets being where they are right now, the prices don't reflect the true fundamentals. So that's all I'd say. Be careful, but it's a long-term investment. If you can buy in on US tech, when it pulls back, everybody's a winner.
Okay. Sorry, guys. I'm tuning in from home after a train strike today, so my internet's not as fast as Carl's is in the studio. It's time for the best part, right? It's time for the community Q&A. Lane, I'm going to try and whip through these. We've got 5 minutes, so short answers, and we should be able to cross them all off. Is that good?
Perfect. You saying I speak too much, Max?
No. Never would insinuate anything. Okay, so from the top, James, why do the regulators allow 30 times or 100 times leverage when professionals are only using 2 times leverage? Why has this now been down on?
So, Max, I think I got the bulk of that. Leverage. Why do the regulators use it? That's what I've kind of summarized from that. It's a great question, and one I would agree with, and I guess that's a question for the regulators. We're certainly seeing a clamp down on a number of these kind of spread betting type firms, CFD type firms, and there are some good ones out there again. But the ones that are less good, I'm seeing now migration where all of a sudden they're getting licenses offshore, because ultimately with their business model, it isn't applicable in hopefully an ever evolving, better UK regulated landscape. But yeah, it's probably not a question for me. It's a question for the regulators. I don't believe, I see those things and I see the stats. And look, it isn't me, and I'm not singling out any company here. Look at the disclaimer on every single retail broker website, and it almost defies belief. I think if one of them is 70% of people who trade here lose money, they would be happy with that. Majority of them are 80, 85, and some are in the 90s. But look, let's not name any names. Great question, though.
No worries. So next question. How much proactive investing do you have to be doing to buy the dip and sell the high?
Okay, so in regards to how proactive do you have to be, again, I can talk from our experience. We're not particularly proactive. We aren't traders, how some people perceive traders. We're not moving in and out of the market. The bias that we're built at the moment, Max, we started to build that probably mid-November. Hence why, so obviously when I say we had a bad November, we didn't start short selling November the 1st. But as markets start to creep up, you start to see a market neutral position evolve into a slight short sell, evolve into a larger kind of short sell bias. So that's kind of how we would operate it, but we're not particularly proactive. Like I said, probably this year, there have been 4 occasions where we've waited patiently, and bear in mind, we're in the 12th month of the year. We've waited patiently for the market to retrace, and we've bought back in. Now, nobody can guess the exact bottom, and we don't claim to, but if we can get somewhere close to the bottom consistently, and as the markets come up again, we'll never get out of the top, but somewhere close to the top, it's those tweaks and modifications that, like I said earlier, take a portfolio that tracks the market to one that beats it consistently. And we did get slightly fortunate with timing on one occasion this year where we were on the short side of the market. And I remember putting a video up. I was away at the time, and it was just as the geopolitical tensions were really kind of, building a little bit of momentum in Israel and Gaza. And I put a video up saying, look, for the first time in a number of months, our clients now, our strategies now have a net sell position. And I guess fortunate, like I said, always hard to time a short sell. Markets came down quite quickly. I noticed a number of positions go market neutral and then bought the dip once again. So yeah, I wouldn't say you should be particularly proactive, because that's where brokers make money. The volume on our strategies is relatively low. It's probably why none of the retail brokers want to work with us, Max.
Yeah, that makes a lot of sense. Now we've got 1 minute left, so I'm just going to ask my favorite of the questions from Mike, because it's a personal question I ask myself all the time. If I'm investing, in your opinion, is it better to have that I build a portfolio that's a diversified group of ETFs than picking a diversified portfolio of individual stocks myself?
It is a great question. I don't know if I have a definitive answer. I think it depends on the individual in question. I think the key there, and your man Ray Dalio said it earlier as well, the key is diversification. So if you can have a diversified basket of ETFs, you're halfway there. If you can have a diversified basket of individual stocks, again, you're halfway there. If you could have a diversified basket combining both, even better. Diversification is key.
Amazing. Well, look, Finimize community, we've been blessed with Lane's time. Go check out TPP. And thanks very much. Stick around for the next session. It's been great to be back on, and what a day. We kick things off with Ray Dalio, and we're building momentum with Lane here. So excited to see you all in the next session. Thanks so much for your time, Lane.
Thank you, Max.